Hello and welcome back to All Things Money. I'm your host for the show, David Blain. During this segment, we're going to continue our discussion a little bit on behavioral finance. We talked about how investors in the U.S. withdrew a massive amount of money from U.S. funds so far this year. Meanwhile, Warren Buffett has been pouring money into stocks at the fastest rate in 15 years. And so that is a great introduction for what I like to call behavioral finance. Well, I didn't come up with that, but that's the term that we use, behavioral finance. And the subtitle of that is Why Watching CNBC Won't Make You Rich. In investing, there's the whole theory of the efficient market hypothesis, and then there's behavioral finance. And since 1950s, researchers have been looking at the whole efficient market hypothesis postulated on investors that are rational and they evaluate carefully all the options in the marketplace. They hold the market portfolio, evaluating the risk and estimated return of all these securities, and come to a logical conclusion as to what to own. Well, we can see that, based on the dot-com bubble, the real estate bubble, the financial crisis of 07, 08, going back to the oil crisis, 73, 74, the crash of 87. I mean, you pick a crisis, that these models do not adequately represent investor behavior. It goes all the way back to the 17th century. We've talked about this before on the show, the tulip bulb mania, when investors were speculating in tulip bulbs. So anyway, in recent decades, researchers have been looking at why this is the case and why investors make short-term decisions that are contrary to their long-term financial health. And it's simply that the investors' decision-making has not evolved very much since the beginning of time, and that people are still sort of hardwired to avoid confrontation, avoid danger, things like that. For example, if you were standing in a hotel lobby and a bunch of people started yelling fire and ran past you out the front door, most people would not stick around to verify that the hotel was in fact on fire, that they would run out the door with the rest of the people. It's what we call the herding mentality. And, as the caveman mentality, that certainly would help you survive from, the woolly-toothed mammoth or whatever that was chasing you down. In financial markets, it's not always a good thing, because this herding mentality creates these big bubbles and big busts. Warren Buffett buying when others are selling is a classic example of contrarian investing. That is an investment style that goes against the prevailing market trends by buying assets that are performing poorly and selling assets that are doing well. Most investors do the opposite. They buy high and sell low. Now, there's nothing wrong with buying high and selling higher. It's the buying high and selling low that gets us into problems. However, there are some caveats to that as well. We see that according to Dalbar, which is a research firm, that investors experience twice the pain of a dollar loss than a pleasure and a dollar gain. And this is true when you think about it. If you have a dollar and you make a dollar, it makes you happy. But if you have a dollar and you lose that dollar, there's twice as much pain associated with it. People focus more on errors of commission than omission. What that means is that they're more worried about making an active error than doing nothing, for example, so they just leave their retirement funds in a money market account. They have a fear of making any mistakes, even though professional investors make plenty. Investing is not an exact science. And for example, even in baseball, the best hitters, only get a hit 1/3 of the time or so. Investors tend to project short-term performance into infinity. They also tend to, quote, fight the last war, meaning that whatever happened recently is the way they structure their portfolio. They also tend to focus too much on familiar companies and industries, what we call the home country bias. The U.S. only makes up about 40% of the world, but yet, and I hear it day in and day out, all about the S&P 500, what's the Dow Jones doing? And they forget that, in fact, the Dow, which is 30 companies, is a very small part of the entire world's market. They also avoid taking losses, but are quick to take profit regardless of the tax consequences. So this is not to contradict what I said before. We want to buy low and sell high, but if you buy low and it goes lower, you may want to think about selling. But people have this anchoring mentality of, oh, I paid this price for it, I just need to wait for it to get back to that level, and that is a big mistake. It causes people to do things contrary to their long-term financial health. Also, most people cannot adequately balance risk and reward. They're often at extremes. We see things like people investing on margin, leveraging themselves, 10, 20 times. Or at the opposite extreme, you see people completely terrified of taking any risk at all, and they don't invest in anything. They just leave their money under the mattress, so to speak. So these are some things that you need to be aware of so that you can counteract them. Let's talk about them once again. Investors experience twice the pain of $1 loss as $1 gain. They focus more on errors of commission than omission. They have a fear of making any mistakes at all, even though professional investors or sports players make mistakes all the time. They tend to project short-term results into the future indefinitely. They tend to fight the last war, so to speak, the recent history. They focus too much time on familiar countries, industries, stocks, and they avoid taking any losses but are quick to take profits. Well, that takes us to our next break. When we continue, we'll continue our discussion about this topic. For All Things Money, I'm David Blain.